Hello, ladies and gentlemen. Greg Michalowski from ForexLive.com. It's the Forex Quick Look. I'm going to take a look at the dollar versus Canada because interesting technicals are coming in play in that currency pair. Let's start by looking at the daily chart. And when we look at the daily chart, the 50% retracement often is a level that technical traders will look at for either support or resistance, depending upon which way you're coming. And in the case of the dollar versus Canada, the market has been moving down in the month of June, all the way down, and we moved down to test the 50% retracement. That's of the move up from the October 2021 low to the high price that we saw, I guess, here in October of 2022. So the 50% retracement comes in at 1.3132. And if you look at the low price today, it reached 1.3135, just 3 pips short of that 50% retracement level. So why did the price bounce off that levels? Well, traders like to lean against key technical levels. If you were to buy at 1.3136 or 37, something like that, your risk is a move below the 32 level. That's risking a little to make potentially more than a little. And as you can see, the current price is trading at 1.3159. So if you were to buy at 37 or 38, you're already up 20 pips on that trade. What was your risk? Maybe 8, 9, 10 pips. So a 2-to-1 profit to risk ratio is not a bad move for traders. That's what you want to look for in a trader. And you still have the upside potential if this price is going to go higher and you think that the bottom is in place, that 50% retracement is a nice support level for traders to take the price higher. Now, what would need to happen technically for the dollar Canada to show increased bullish momentum? And for that, I want to look at the hourly chart. And when we look at the hourly chart, there are a couple things in play here from a technical perspective for a level that traders might lean against. And the first is this 131.778 level. This level corresponded with these lows going back to June, I guess it's 16th or 18th or 19th, thereabouts. And then we fell below the level through here and then used that level as a resistance through here when the market moved back above the level on Friday's trade. What do? We fell in support against the level. So we've been rotating back and forth between support against the 77 level and resistance against the 77 level. The current trend or the current bias is resistance against that 77.8 level. If we're able to get above that level, we have another hurdle to get through, and that is the 100-hour moving average. Now, the 100-hour moving average has not been a harbinger for increased momentum, at least for a sustained period. I'm outlining all the times over the last few weeks where the price has moved above the 100-hour moving average and then fell back below that moving average. So you can see there's a number of different arrows there along that line where that occurred. So if the price were to get above the 100-hour moving average, what I like to say is we have to stay above that 100-hour moving average. If we are able to do that, then we look toward the green line, that's the 200-hour moving average. And if you notice at this line right here, there are no breaks of the 200-hour moving average all month long. You have to go back to June 1st. In fact, to find a break where the price moved above the 200-hour moving average. That was only briefly. So getting above the 100, or getting above the 77 level, getting above the 100-hour moving average at 84, getting above the 200-hour moving average at 132.14, those are all the steps that need to be happen in the dollar versus Canada to increase the bullish bias. So overall, what do we have? Support at the 131.32 level. That's the 50% retracement level off the daily chart. And what do we have as resistance? We have resistance off the hourly chart against the 77 level, the 100-hour moving average, 200-hour moving average. Those are the technical levels in play. We'll see how it all plays out. My name is Greg Michalowski. Good fortune with your trading. Bye-bye now.